Hello everyone and welcome to the Strategy of the Day update for January 7, 2019. I'm Dan Hussey from Zaner Ag Hedge. Remember, trading futures involves risk and is not involved or suitable for all investors. And everything I say today is my own opinion and not a direct trade recommendation. So I wanted to start talking about the March 20 corn contract. It's been a little softer in the trade here the last few days, where it was actually holding up rather well into the end of the year there relative to beans and wheat. It had not really broken out and followed through to the upside on new levels. It had actually led the grains in early December and kind of just held on to highs where we didn't see as much volatility. Anyway, we traded down to a fresh December low, or January low, excuse me, yesterday on Monday. And today we've traded basically inside price action of the range that we've been holding and flagging at lows. All in all, 2-cent range on the day is really nothing to speak about for corn, and I anticipate either a bottom maybe formed already. If we can see a reversal here, we could see that inside day type reversal candlestick structure play out. But the 50% Fibonacci retracement at 381.50 that I pointed out before, it's also a gap fill that we have open on the chart from December 15th. That would be a logical place for support in this market if we were to test, into new lows and get one more capitulating low and reversal. Which, hey, look out for that. We got WASD coming out this weekend or into this weekend with quarterly grain stocks as well, where corn may be one of the surprisers, and certainly from many trade analysts' standpoint, we've become somewhat friendly on the November highs, the WASD high. The November WASD high, I should say, is that cap we've seen on the market here in January at 392 highs that we failed to break above. But if we are to penetrate through that level, there isn't much in the way of this market getting back towards the November high of $4. And through that psychological level, I think we're on towards the 410 and 420 threshold rather quickly. But we'd have to get ourselves above, because when you do take a step back on corn, you have to remember. We might be still in a bit of a range. Let's look at sister in the beans, and you can see a range there that we've had, and this range could be as high as 411 down to 370, or just 392 to 370. We've just been building a supportive level down here for the last several months and into 2020. So like I said, 392 is a key level to watch for. If we get a rally in the corn and can penetrate through that level, I do believe we will see a revisit of the 410, a $4 November high and 411 October highs to follow. But as it stands right now, really quiet market, and I'm surprised I found so much to say about a market where there wasn't much going on today. Beans, on the other hand, we covered this in my last write-up, as well as last week in the video. We talked about this blue range I have with this rectangle on the chart, the 933 to 940 area congestion zone that the market spent the last few days of December, breaking above January, putting in a new high, and then reversing after the new year here back to retest that broken resistance, now a support. If we zoom in here on the 1-hour chart, you can see a technical head and shoulders pattern with maybe a left shoulder here forming at the 946 to 950 area, the head up at the 961 highs, and the 947 to the 50 area could form the right shoulder. Now, I don't really trade head and shoulders patterns. I wouldn't ignore it though if we would go below the 949 line. That's certainly something to think about, but I'm not one to trade a head and shoulders and sell into this rally, because I find them to be oftentimes a trap. This type of highly technical, highly visible trading setup is oftentimes targeted by stop hunting in the market, and at this point, with the geopolitical situation, with phase one deal, with exports looking decent, and a WASD report on Friday, and quarterly grain stocks as well, not so certain I would take that type of trade to fade a market that when you take a step back in beans. Speaking of ranges markets have been in, the dollar range between 960, 970 highs and the 880 to 870 lows. Though that range could break if we get above get above our January high, because we would be, conceivably breaking above it. And hey, if beans were caught in a dollar range for 6 months and they break that range to the upside, it's from a statistical standpoint, it's very probable that we'll see a dollar rally up from the high end of that range, taking us well above $10 towards 10.60. I'm not calling for beans to go to 10.60 at this time, but if we start to go above 9.60 highs of January, above the 9.70 highs and contract high for the range that we've been in, and not the contract high itself, but for the March contract, it's the high for that range. If we get above those levels, that's something we could be considering and talking about. Bringing up, the smaller time frame here in the chart, though, wanted to point out that we've put in basically a triple bottom 3 days in a row, 3 lows in a row for 3 days. Into this 940 area, so it's very much proven support at this point, and it's up to the bulls to drop it. So if we do run stops and head below it, there are levels to the downside to consider. An open gap at 921 in the soybeans, in the March soybeans, the 921.90 full 50% retracement of the 882 low to 961 highs, a B as well as a valley in our volume profile. Volume profiles, for those that aren't aware, you usually find these the taper of volume, or the valley in volumes around highs and lows, because where ranges trade, where market is traded many times over and over, that's where you get a high cluster of volume, because it's built up over time. So the range we've had between 940 and 960 in the March soybeans has built up considerable volume on this volume profile, which is the bluish histogram on the right side. So a cluster of technicals down around 920 would be our better support if we start going below the 940 neckline of this head and shoulders pattern. So lots of technicals lining up on a chart, and when a market starts to become technical, after a period of maybe confusion like we've had for the last several months in soybeans, and we have had the same fundamental story the whole time, this is the reason that you might start seeing funds and other type of traders come into a market that can be the propellant to help it burst through a threshold like 960, 970, or hold it, fail, and fall back down into the range. Of course, it sucks in other longs that don't that end up becoming the fuel for the fire to the downside. But right now the chart is holding a 940 support. We've got 948 resistance in the near term. We're kind of breaking or pushing against resistance trend lines. Beans have had a history of rallying in the overnight session. They did in the late or early fall. So I would not be shocked to see if today was in fact a turnaround Tuesday. If we can get above 948, there's really not much in the way to get back towards the 961 highs again. And if we were to go through those highs, there's conceivably 6 months worth of stops or market activity, right, keeping the market below that level, that would now be failing. So that's something to consider, that it may be a big move if it happens. I'm not calling for it to happen or anything, but it's within striking range. Within 1 day's worth of typical price action in the soybeans, you could see us back to those levels. So that's not something you can ignore. Just like in 1 day worth of typical price action in the soybeans, we could be down towards the 920 area as well. So lots of technicals to consider, and
I'm not exactly sure what that means for export.
A support level that, until it fails, I have to consider this trend up intact, and the market targeting towards maybe a 970 area at this time, while above 937 lows and the lows of January so far. The Chicago wheat contract, been a pretty choppy move higher, but very, very, very technical stair-stepping pattern to this market, that when you take a step back to your daily chart in the March wheat, you see we're breaking above a pretty long-term trend line, multi-trend line highs on a daily, that we've just built up all of this potential energy to break through. Now we're going through the levels. We've tested them, broken resistance as support. 1, 2, 3, 4, 5th month now of higher highs and higher lows for Chicago wheat. It's a bull trend. It's not a sexy, glorious rocket ship firing off into the stars runaway trend. but it is technical, and it has continued to stair step higher. And when you dive down into support and where things might be in the near term, coming down to an hourly chart, we have a lot of support below us. We have now broken highs from October and November, which have been tested as resistance, and then once we broke through, again as support. Those are those blue dotted lines on this chart. You also have that longer term trend line here, sloping trend line coming through the market that we're pushing through. Momentum obviously has waned to the downside today, with today's close back at near highs of the day. It looks like another kind of typical Tuesday reversal here, turnaround Tuesday reversal for a market, and we broke the trend line off the highs. Depending on how you draw this trend line, it looks like it has been broken, which means that we're probably going to be in a period of price discovery. 555 resistance in the near term, 560 is right above that, 565. So every 5 cents we'll have a little bit probably to chew through, but every time wheat has taken off, when it does, it's a fairly sorry about that. It's a fairly quick move. We had a 25-cent move in just a few days. The last rally up before that, we had a 40-cent rally, with the first day leading off with 15 cents and largest day being about 20 cents there at the end. So seeing 15 or 20 cent up day here, if this wheat's going to start to break out, is what we would expect. Is it trade worthy? That remains to be seen, but hey, we're breaking above resistance. We're coming down to testing it as support. If there's ever a time to look for that low risk opportunity where you can use a prior day's low or a monthly low as a stop to manage risk, right? Because half of what we do in trading is obviously picking out the trade we think will be a winner. The other half is how do we make sure that if and when it does become a loser, it doesn't burn us to the point where we're, one, either not here to take the next trade, or two, that it was appropriate, risk for size of the account and all of that good stuff. So, but from a speculative perspective, there's only 5 cents down to the lows of January here, and we've got 17 cents back to the highs. So there's more room to gain back up to the highs of the month than down to the lows. And because we have technicals and cluster of other reasons that we might have support at these levels, now we've got the rationale from a technical perspective behind the trade. You've got rationale from a price perspective behind the trade, that getting into the market here is only a 5 cent risk down to the low of the month. If you were to put a stop there, and your potential upside target, right, of prior highs or maybe new highs from other projection targets that technicals can give you, like I see wheat up to the 580 area in the near term, or on the next leg up if it goes, which would probably quickly lead to a retested $6 psychological threshold and beyond, where the March wheat contract contract highs actually come in around 640. So when you step back and you see that if we get through the 567 area, we also are getting through the highs of last summer that were at 572. You start to realize that, okay, like the soybeans, wheat might have the potential here to break out of a larger trend if it doesn't fail here. And we have levels in the short term that we can say, hey, maybe the trend up is defined by this level of support in the near term, and if we see it continue from this level higher, we decide that trend is remains intact, and the market should continue higher. And if it does continue the most bullish sentiment of what we think, we've got pretty big moves potentially coming from a technicals perspective. If it fails here and rolls over, we have pretty big ranges the market can trade back lower into. So there's some lines in the sand to watch, and to keep you up to date on the news here. Tomorrow we only have dairy production sales for the ag products. Not really anything going on news-wise until Friday, the 10th here. We have USDA supply and demand estimates, wood and wheat seedings, crop production, grain stocks, the quarterly grain stocks. That is one of the kickers in the hold that day, as well as unemployment numbers helping, which is generally a more volatile event for the broader market. So, well, that completes today's wrap up. I just kind of wanted to go over the grains, just to say 2 cents on the cattle here and the hogs. cattle seem to push through, pushed up to test highs. A little back and forth price action today. We saw some good support. If they can push back through those November and December highs that we were just making, looks very good. Otherwise, live cattle might still be in a bit of in its range it's been trading in between 124 and 120, call it 8 in that Feb contract. And the feeders, we don't want to see them break down below the 143 December breakout level that we held as support that sent us back up into January highs, which are also the November highs. So with that being said, I'll be back with everyone as price action develops. Take care, everyone, and have a great day.